Last night I was watching a replay of Ben Bernanke's testimony in front of the House Financial Services Committee yesterday, and my kids were giving me a hard time. They were saying a couple of things. One, they said that you can't understand anything Bernanke says. And the other thing is they were saying that the people who were supposed to be asking questions were just making speeches. You know what? My 11-year-old kids were right. They were right about both of those things. Now, most of the commentators today in the paper and in newspapers and on television, they've concentrated on the parts of the chairman's comments where he talked about the economy continuing to be weak and the possibility of the Fed continuing to buy bonds. But you know what? There are two other things that I heard. Here are the things that I heard yesterday. I heard a guy who was frustrated. He was frustrated that people don't understand quantitative easing, and he was frustrated that $3 trillion worth of stimulus either hasn't done very much or it doesn't appear to have done very much. And there's another thing I heard from Bernanke, and I haven't seen much about this in any of the commentary this morning. The one thing I have seen is something that he mentioned early in his comments. Early in his comments, he talked about inflation. He mentioned that inflation this year, in the first half of the year, has been almost 5%. But then at the very end of his prepared remarks, almost 14 and a half minutes into a 15-minute speech, what he said was that he was prepared for the Fed to go from an easy money or an accommodative position to a less accommodative position. Listen to what he said.
Subsequent steps would include the initiation of temporary reserve draining operations and, when conditions warrant, increases in the federal funds rate target. From that point on, changing the level or range of the federal funds rate target would be our primary means of adjusting the stance of monetary policy in response to economic developments. Sometime after the first increase in the federal funds rate target, the committee expects to initiate sales of agency securities from its portfolio, with the timing and pace of sales clearly communicated to the public in advance. Once sales begin.
That's the scary thing coming out of Washington right now, and that's what we've been worried about for over a year. Bernanke, here's the language he used: reserve draining and security sales. That's the opposite of quantitative easing. See, what the Fed's been doing is by buying bonds, they've been pushing interest rates artificially low, which has been pushing investors into riskier asset classes. Well, what happens when the Fed not only stops buying bonds, but when they start selling them? That's what we're concerned about, and that's why we're so focused on balance sheets right now. We were looking at a company recently. This is a company that's a leader in its industry. They're incredibly profitable, but they have a lot of debt. And because of their debt structure, when interest rates begin to pick back up, their interest expense will increase so much, and it won't even take a big increase in interest rates. Their interest expense will increase so much, it will consume every bit of their earnings. And you know who the company is. That's one of the kinds of risks that we're concerned about in the stock market right now, and it's one of the things that Bernanke hinted about yesterday.